All right.
All right, great. So I'd like to welcome everyone to the Web3 and Society Cryptoeconomics Salon with Alex Tabarrok. With this series, we're hoping to create a thoughtful and accessible and fun forum for anyone interested in how crypto works and how Web3 works and its intersections with civic participation and the financial system, culture, and science. So it's okay if you're hearing about Web3 for the first time, or if you're, it's just fine to be totally skeptical. We're here to learn together. So I just want to set a couple of house rules. I will paste these into Zoom chat. So we'll be here for about an hour and a half. You should leave your cameras on if possible and mute unless you're speaking. If you would like to speak, you can raise your hand in Zoom, or you can post a question in chat. So I'll be watching the questions and trying to weave them into the conversation in a fluid way. And if you want to connect with other attendees later, feel free to post info like your Twitter handle and your interest into the chat. And of course, have fun. So I think why don't we, since it's a small group, why don't we actually start with just a very short round of introductions? Maybe Alex can go first.
Sure, Alex Tabarrok, economist, George Mason University.
I'll call on someone. Sean.
Hi, Sean Patrick Hughes. I'm a tech leader for a Valley-based tech firm and blogger, writer online.
Hi, Sean.
Grin.
Grin, founder and CTO of Library. Alex is actually our advisor, technical advisor, economic advisor at Library.
Great. The other Alex.
Hi, I'm the co-founder and CTO of a nonprofit that helps governments leverage technology and based in San Francisco.
Abhinav?
Hi, I'm Abhinav. I work as an IT consultant. I've just joined to basically listen in and learn a bit. That's me.
Great. Kena?
Hi, I'm a full stack developer and a project manager. Happy to meet you.
Cool. Orpheus?
Hi, everyone. Orpheus. I am a data person generally. Previously worked in big tech, most recently at a crypto firm. Yeah, happy to be here.
Cool. And I'm Wes. I work at the MIT Center for Constructive Communication. I run a small research engineering team there. Great. So let's see, we're speaking on November 19th right now, for those of you who are watching this on YouTube later. And the big news for the last couple of weeks has been everything going on with FTX and Sam Bankman-Fried. So this seems like a good place for us to start. So Alex, can you give us a kind of like a macro overview of what's going on with FTX?
Sure. So I thought I'd give kind of a conceptual overview, and rather than going into the details, of course, a lot of which will be coming out in future weeks and months. So to think about this, like just imagine that I own a house. Okay, it's kind of how it starts. I own a house, and then I create a million coins which represent my ownership of the house, and I give 500,000 of them to my wife. Okay. And then my wife also buys one of the coins from me for $10. So now, based upon that $10 valuation of one coin, of which there are a million, my house, on paper at least, is worth $10 million, right? Now, that sounds a little crazy, but okay, let's go with that for a minute. Now, let's suppose now that I ramp this up a little bit. Like, no one's really going to believe that, but okay. But suppose I ramp it up a little bit. I go to my friend, who's nominally separate. I go to my friend Tyler, okay? And I say to Tyler, will you buy one of my coins, one of my 1 million coins in my house for $15? And in addition, I'm going to make like a kind of a side deal with him. He might not want to buy one of my ridiculous coins, but I might make a side deal with him. I say, look, I'll give you an extra, 5% of our textbook royalties. Okay, I won't really tell anybody else about this side deal, but because of that side deal, we have these other things going on. He'll say, okay. So now he buys another coin for $15, and suddenly these coins have gone up in price by 50%, and my house is now worth $15 million, and I've got, $7.5 million. My wife has got $7.5 million, and maybe other people, seeing that Tyler has bought in, maybe a few of them will buy in as well. So what is the analogy here? Well, if you're not sort of already clued in, I'm Sam Bankman-Fried in this analogy, and my wife is Caroline at Alameda, who had a romantic interest with Sam Bankman-Fried at some points, and we've created this coin. Now, who is Tyler? Well, Tyler is perhaps like Sequoia. So Sequoia, they made a investment in FTX and in Sam Bankman-Fried and his organizations. And at the same time, FTX made an investment in Sequoia. Okay, so that's kind of weird, right? Right. But now you can kind of see how kind of these back deals, I'll invest in you, you invest in me, will push the price of these coins, and then other people maybe will come along for the ride. Now, so far, of course, the actual amount of money which has changed hands with these coins is not that much, right? We have these massive valuations based upon tiny floats, and not that much actual money has moved around. But now suppose that I, as Sam Bankman-Fried in this analogy, start a bank or an exchange, okay, held at my house, right? And I could get quite a few customers, especially those who aren't paying that much attention, because look, I've already shown I know how to get rich. I created these coins, they went up by 50%, 75%, on paper, I've got, $10 million house or $1 million house, whatever. And, things are going well. Okay. So he gets these deposits into the bank or into the exchange, and people, use their deposits to buy the deposit dollars or perhaps Bitcoin, and they buy other cryptocurrencies, or, they could be buying anything. So now I have this stack of deposits, right? And that's real money. That's not fake. It's not all fake coins. Maybe some of it is, but it's like Bitcoin, but it can also be dollars, like real money. And so now suppose I use some of this real money I lend it to my wife to make investments with. And she's going to make a whole bunch of other investments with these real dollars now, which have come in based upon my reputation and based upon the increase in the value of these coins. She's now going to make investments in other things with these real dollars. And that's serious money, okay? And that's what happened. That's what Alameda was doing based upon loans from FTX. And at first, this looked great because in 2020, 2021, the prices of all of these cryptocurrencies, crypto tokens, was going up. It's just a tremendous, tremendous run. And not only, so since Alameda is buying tokens which are going up in price using this borrowed money, Alameda gets all of the increase on the upside. Okay, they have massive, massive leverage. All they have to do is pay the coins back. Okay, all of the upside is theirs to keep. So it's an incredibly profitable strategy when things are going up. You have massive leverage. Now, what else? So everything is going great. It also looks like, was this legal? Was it illegal? It's actually a little bit hard to say. We'll figure, I'm sure a bunch of it was illegal, but like if the purpose of a bank is to lend money, to invest in things. So if it was a bank, it could be legal. Maybe it wasn't wise, but could be legal. An exchange is a little bit different, but there could have been issues where even it was legal for Sam Bankman-Fried to lend some of this money to Alameda to make investments. And at the beginning, this also looked very safe. like on paper. Like why? Well, because on paper, you are lending the customer the money in the customer's accounts to Alameda to make these bets. But remember, Alameda, or my wife in the analogy, has got these coins, which on paper have got a pretty high valuation. So the collateral, at least on paper, looked pretty good. And then Alameda or Caroline or my wife, whoever you want to, whether you take the analogy, the coins are going up in value. So the collateral even looks great, right? Like on paper, it looks like not only have you got the original collateral of the coins, which were the fake ones that sort of created that in the house, but you have the stuff that is being bought and that's going up in price. So even if it fell by 50%, you'd still have enough to pay back, you know, your depositors. Then what started to happen, you know, end of 2021 is crypto prices started to fall. And once things start to fall, people take a closer look at what's going on, right? And then they begin to, you know, worry. Like one of the things, and one of the amazing things which happened was that Voyager and BlockFi, which are also firms in this space, they looked really shaky. They'd made some investments in Luna, which had collapsed, so-called stablecoin, which had collapsed. They looked very shaky. And at the end of 2021, or at the end of, beginning of, end of 2021, more recently, Sam Bankman-Fried then said, I'm going to step in and save these guys. And at that time, he was called the JP Morgan, you know, of crypto. And my Zoom background is JP Morgan's library in New York. So he's being called the JP Morgan of crypto for having all of these assets and for being willing to step in to save the whole industry. Well, that was what it looked like at the beginning. What we now know to be the case is that these guys he was so-called stepping in to save, he actually owed them a lot of money. And he owed them money. The collateral was, again, these coins in the house, okay? And so he didn't want them to start calling on their coins because that would break down his firm. So rather than actually stepping in to save them, he was stepping in to hide the cracks in his own empire. And in fact, it looks like, I don't know whether this is true or not, but it looks like when he stepped in and took control of these firms, he also got control of the accounts at those firms, which he then used to make even more bets. So this was a case of, you know, a double or nothing, trying to double or nothing multiple times to try and get him out of this hole. And of course, once it starts to collapse, then the whole cards comes down. People realize, oh, this collateral, that was just based upon this 1 or 2 or 3 trades. You know, the float was really small in this house. You say this house is worth, you know, $10 million, but that's just because there was one $10 exchange on a base of $1 million coins. But these coins, you know, they're totally ephemeral. You don't really represent value. So that's when the whole thing came collapsing down. Final point, and I'll stop. Let's suppose now that I just add to my little analogy of my house. Imagine that to help me run my firm, I invite a bunch of my friends and we do a lot of drugs and have a lot of sex together. And none of us know accounting, okay? We're all like whiz kids, you know, from MIT and Harvard, but none of us has actually ever run a firm. None of us we all think we're whiz kids, so we're not. None of us is the boring, bespectacled person who keeps control of the accounts, right? And you really need the adult in the room. You really need these boring people who write everything down and who follow every dollar and every cent, and none of them did that. So not only do we have massive speculation, potentially fraud, but we have, by the guy who is now running FTX, who's coming to take over, Ray Fair, was the guy who also took over Enron. And he says it's way worse than Enron. I mean, the books are a complete disaster. Nobody knows who owns what. It's not even clear who owns or owes. It's a complete, mystery, and it's going to take months and months and months to unravel. So that's the FTX saga, as I would summarize it.
In that, yeah, that's great. And what's particularly striking for me actually is that your entire story here, doesn't really require any knowledge of crypto. This is just like right stuff that can happen in the real world. Right?
Exactly. So that's the irony, and that's the tragedy of the whole thing, because crypto is going to take a big hit reputationally, and yet everything which Sam Bankman-Fried did was centralized finance. The assets were crypto assets, but they could have been dollars, they could have been yen. That actually has very little. The crypto part of it doesn't have that much to do with it. This is old style banking runs and bank fraud.
Yeah. Where in that analogy would CZ fit, do you think?
Yeah, so right. So CZ runs Binance, which is another crypto exchange. Different perspectives. Was he the genius who kind of saw what was going on, and because of a long-standing grudge, managed to destroy the whole thing? I think actually he was maybe, I don't know. I think more he actually just got a little bit lucky. He was just a little bit ahead, and I was going to say it was like Jenga, and he pulled it and the whole thing collapsed. So maybe he was the last one to pull. So I think that was kind of what happened. Technically, so what he did, he had a bunch of these coins, which we were talking about. Between my wife and I, we make these coins. These are the FTT coins. He owned a bunch of those. He'd been given those as collateral or for some other reason. Yeah, I think when he had a stake in FTX, so he'd been paid off in these coins. And he said, I'm going to sell them. And Sam Bankman-Fried knew that if CZ were to sell all these coins on the market, there was no way, there was no demand for them. The price would instantly, collapse, because the market price had been based upon, selling this one coin, right? And now you've got millions of them being sold. And that would just depress the price, which would start the bank run. So he and Caroline, Sam Bankman-Fried and Caroline, tried to avoid that as much as possibly. They tried to buy him off. We'll take these over the counter, from you, to try and stop the bank run. And, that didn't happen. So CZ was kind of the straw which broke the camel's back. He said, we're going to sell these. And then everyone ran for the exits.
Yeah, I mean, notably, so they made, I guess, like a public offer to purchase at a certain price back from him, and he said, "Oh, I prefer to just leave it to the markets." I mean, I don't know what his stake was in FTT,
right.
But he must have lost quite a bit of money in not taking that offer, right?
It depends. I mean, would he actually have been paid, or would they have, given him? Oh well, okay, it's coming. The check's in the mail. We'll give you in this other coin we have. I suspect maybe they would have scrounged enough money to pay him. Maybe they wouldn't. It's hard to say. So maybe he wanted to collapse the whole thing because he hated Sam Bankman-Fried. I don't know. Yeah.
So regarding FTT, was it not traded at all on like any AMMs or like decentralized exchanges?
Right. So let me give you what again, I'm gonna say conceptually, big picture view, because the details are hard to know. So there was a massive look. Going back to the analogy with I create these million coins. I give 500,000 of them to my wife, and then we trade one of them. Okay, that's essentially what was going on. So the amount of trade or the float was on a very small portion. So in order to keep the price up, right, all FTX had to do was to keep the price of the the relatively small number of exchanges relative to the total supply, okay? And a lot of these crypto coins started out that way as well. So like Serum and these other coins which Alameda bought, they typically have some of the coins are created at the very beginning, but then there is a emission schedule, okay, where these coins are going to be released over time. And the initial amount which is sold is small relative to the total amount, which is going to be released over time. And every little while there's an emissions, right? Like Bitcoin, every block creates more Bitcoin. So with many of these other coins, it was very similar in that there was an emissions schedule. So in order to keep the price up, you really only had to control this float. You had to control the relatively small number of exchanges relative to the total stock, right? And so that's what they tried to do. So a lot of it's hard to know, like, how did they lose all of this money? Like that actually, I think, is the biggest mystery of where exactly the money went, because it's they bought a few penthouses and things like that, but it's not obvious who were the big gainers, where did the money actually go. But one of the things that they were doing was buying up the emissions in order to keep the prices of these coins high. And doing that again and again and again, I think was expensive.
So essentially a literal Ponzi.
Yeah, it's a kind of Ponzi, but there are legitimate reasons for having a model like this, because there are scenarios in which the market gets bigger and bigger over time. And you don't want to put all of your coins out in the market at once. It does make sense to have an emissions policy. It's a monetary policy, and to release them over time. So there are scenarios in which this could have worked out. So I'm a little bit reluctant to call it a Ponzi, as that suggests kind of a legal determination.
Yeah.
But it definitely has aspects of that. Yeah.
So is the true issue then that the underlying assets evaporated and we don't know where? Like if those outflows hadn't occurred, in theory, the structure is still in place for it to be a viable strategy. Or am I thinking about that wrong?
Well, so they own these coins, so they have a big part of their. Okay. The coins, in my analogy, would start the whole process going. Me selling giving the 500,000 coins to my wife. That is the FTT coin, which sort of represented the house, which is FTX. FTX now looks bankrupt, and so the coins are worth nothing. Those coins. There are other coins, like the biggest one that FTX or Alameda owns is the Serum. I'm actually not sure before FTX, I'd never heard of Serum. So I'm not sure what their reason d'etre was, what Serum was supposed to be doing, was it a layer 1, a layer 2, maybe Grin knows. But maybe like those coins are still worth something, maybe, but I don't actually know. I don't actually know what the plan was for those Serum coins, whether they're worth something or nothing. I'm not sure.
What was the specific mechanism, I guess, by which everything started to fail? So if the value of the FTT tokens is collapsing, then Alameda was receiving like margin calls or something? Like what was going on there?
Yeah, so the Alameda had, so some of the money Alameda got was from the FTX accounts, but they'd also like borrowed money. I mean, things were shooting up so high in 2021 that Alameda was borrowing money from other crypto lenders and giving things like the FTT coins as collateral. So those lenders like BlockFi, which FTX bought, okay, when BlockFi was starting to go under, BlockFi, had they not been bought, BlockFi would have been calling in and liquidating that collateral. So had CZ not sold, his 520 million, there were other institutions who had FTT who needed the money to pay their own, lenders, and they would have started to call in that collateral, and that would have, they would have been sellers. So there were other people out there who had big chunks of FTT who needed to sell it, and that also would have dropped the price.
Okay, I see. And so what you were saying before, it's unclear, I guess, like who were the gainers here? You mean that the money that Alameda, like the things of value that Alameda was receiving because they were using FTT tokens as the collateral, like that's gone somewhere. It's like not in like Alameda's bank account or wallet or whatever, right? It's
yeah,
like
so
it's somewhere out there in the world, and they can't get that back, right?
Right. So like they bought these Serum coins, but it's like puzzling to me that they would have paid top price for them. Like, why didn't they get them at a really low price? I don't quite understand that. So somebody, apparently there's at least, and we don't know, we'll find out, I suppose, but there's like an $8 billion hole. And so that money went somewhere. And whether it went to firms who were trading against Alameda, like Alameda is a buyer of its own coin, FTT, in order to keep the price up. So whether people were just, selling these FTT coins to Alameda and making money on that, or maybe the people who sold Serum, I'm not sure. It doesn't, they bought, the stadium rights, and they bought some real estate, but like, it does seem peculiar where the 8 billion went.
Who typically is the recipient of the FTT emissions? Like, is it something like a proof of stake, like people who are like validating transactions are the ones who get the emissions, or is there some other way in? Or
yeah, so it would, so people who have FTT would get a proportion of those emissions.
Oh, okay, I see.
Sort of like an interest, kind of an interest payment.
I see.
Yeah. So there were these emissions coming in, which again were still small relative to the stock, but as people sold them, that would push the price down, and so Alameda was trying to stop that from happening by continuing to buy.
So I feel like the ability for Alameda to have become so levered is one of the core problems here. I mean, is that just a problem of like marking the FTT value to the last trade? Like, isn't there a more sophisticated way of doing this that the lenders would have been able to tell that Alameda actually didn't, what wasn't worth like what that straightforward calculation was?
I mean, it's hard because in 2021 the prices were going up. So like, on paper, it looked like there was a decent amount of collateral, and they kept making money. So I'm not sure that would have helped. I mean, certainly the fact that there were very close ties between FTX and Alameda, that's a pretty big no-no, right? You're not supposed to be lending money to, your wife, as it were, right? So that really should have put up a lot of warning flags. And, you know, Sam Bankman-Fried always said FTX and Alameda are separate entities, and the Alameda gets no privileges, and that just turned out to be lies, it seems. You know, Alameda had massive privileges within the FTX ecosystem.
Grin, would you like to ask your question?
Yeah, my question is, it seems like another case of like Goodhart's law, right? Like everybody's focused on valuation or market cap, which I like basically the same thing.
Yeah.
But nobody really paid attention to that tiny bit of float or like who's holding the tokens.
Yeah.
So maybe is it that, you know, these metrics are bad, or it would be nice if we had more sophisticated metrics that kind of capture the quality instead of just the quantity?
Yeah, absolutely. I'm not, yeah, so I totally agree with you. But again, I mean, you know better than most that everyone thinks they're a genius when the prices are going up. And so, you know, no one looks too carefully when everything is going up in price. You just like, oh, well, I was so smart. You know, I made a great deal. You know, I bought this Bitcoin. Everyone thought it was stupid. And now, you know, I'm rich and they're not. That shows you how smart I am. And so, and it happens so fast, right? This is the other thing. So I think, look, you know, one of the things about our modern world is that communication happens at a much faster rate. News seems to happen at a much faster rate. You know, Twitter just disperses the news much more quickly. So things do seem to be happening more quickly. So look, there, you know, this is not the first time this kind of thing has happened. You know, we saw the run up in 2000, 2001 with the internet, you know, pets.com and all of that. And I was living in San Francisco, in Oakland at the time, and everyone around me was talking about day trading, and, you know, Google was taking off, and Yahoo, and, you know, all of these firms. And, you know, again, the stock prices, you know, just collapsed. So this is not new. I agree with you. The market cap, the float seems like a ridiculous measure, but you can lead a horse to water, but can you make them drink? By which I mean you can give people all kinds of metrics, but will they pay any attention to them when, you know, there's a speculative bubble going on? Probably not.
Was there, I mean, one of the promises I think of crypto and blockchains, right, is that a lot of information is public. Like, was there actually enough information going on about the trading and like how deep the market was for somebody to figure this out? Or is there really a lot that's quite hidden internally?
Yeah, so yes and no. There is a lot that is public. It takes quite a bit of work to sort of uncover it all. I suspect we will find, and there's already some indications of this, that, you know, some people were sending up warning flags earlier, you know, a little bit earlier, not like a few months earlier, a few weeks earlier. So there were things that, yeah, there were some warning, there were some red flags, but it's not. So there's a fantastic word, rehypothecation. Okay, and this is where you lend an asset or you borrow an asset, and then let's see, how's it going to work? Then the person who has borrowed the asset themselves lends it out to somebody else, okay, or uses it as collateral for something else, right? And you can have multiple rehypothecations. And so this means that the way in which the networks are interacted, and we saw this also 2008, 2009 with the shadow banking system, right, is that people were making loans and then counting the loans on the books as, you know, assets, and then those assets were being used to make other loans and from different firms. And so a lot of things were connected in ways where you would not ordinarily have, you would not have suspected that the interactions were so deep, or the connections were so deep. So I don't think it's easy on any single blockchain. Yes, you can follow it, But when you take into account that people are using the assets on one blockchain to buy assets on another blockchain, then it's much more difficult to actually trace all of these connections.
I'm curious what the regulatory aspects here are. Right, like of course, if FTX the exchange was actually considered a bank, right? You know, maybe there would be more capital requirements or like more scrutiny on what sort of investments Alameda would have been able to make, I guess, using the depositors' money. But because it's an exchange, like, are there just no rules, or like what's the state of this the state of the regulation right now?
Right. So my suspicion is that FTX and Alameda violated all kinds of Bahamian regulations. So, you know, people say, okay, they were offshore and, you know, they escaped all these regulations. But my suspicion is that everything that a lot of the things that they did were, again, I want to be careful. This is my suspicion. A lot of the things that they did were already illegal. Okay. Now, maybe you can say that the Bahamians had less enforcement capability. That's possible. So, you know, it is a big deal. FTX came in and, you know, they're a big spurt to the local economy. And, you know, Bahamas, you know, they drink the Kool-Aid that they're going to become, you know, offshore haven for the next thing for, you know, crypto, and it's going to be big. And so they're excited about it. And they don't have all that much expertise, you know, in crypto and in blockchains, and maybe not even so much in banking. They have some, but maybe they don't look too carefully because it's all very exciting. So you could say that maybe it's an enforcement problem. It's also the case, of course, that Sam Bankman-Fried was hanging out with Gary Gensler, you know, the American enforcer. And Sam Bankman-Fried was trying to actually, okay. So as I said at the very beginning, none of what was going on with FTX really is that dependent upon crypto. The technologies, the assets were crypto assets, but this was ordinary kind of bank run stuff. Now, there is an alternative to centralized finance, which is decentralized finance. And that is dependent upon crypto, and that is new, okay? But that wasn't what Sam Bankman-Fried was doing. In fact, what Sam Bankman-Fried was doing was trying to regulate decentralized finance, okay, out of existence. So the irony is that, you know, Gary Gensler, while he's having lunch with Sam Bankman-Fried, okay, is overlooking the massive fraud which is occurring in front of his face. And, you know, I don't know if Grin could take it, but he's, you know, he's attacking, you know, library, and he's attacking, you know, he's doing a bunch of ridiculous stuff, which is not helping anybody. Okay. So like, would regulation have, you know, prevented this? You know, it was already illegal. Our regulator, maybe, I don't know. You know, like, I think Coinbase, okay, I will say, like, Coinbase, I think, is in good shape. Okay, it seems to be on the up and up. It seems heavily, you know, a lot of oversight. But the American regulatory system does not look good coming out of this either.
How much of an analogy is there to like traditional, I guess, dark pools? It seems like there's some elements of this going on, right? There's a big trading operation there, and right, and Alameda was supposedly taking advantage of preferential access to order flow in on FTX. Like,
yeah,
is that a real part of the story, or?
Well, again, it's peculiar because that was always the kind of whisper, right? That Alameda was getting access to order flow from FTX and was using that to make money. But the problem is it now turns out that they were losing tons of money. Okay, it's not that they were making money, and it now looks more like not that Alameda was making money by getting FTX order flow, but in fact that FTX was subsidizing Alameda, okay? And maybe Alameda was losing money on its order flow side. Like Alameda started out as a trading firm. Like originally Sam Bankman-Fried's claim to fame was that he created this arbitrage in Bitcoin with Japan, and he made some money doing that. That was his original claim to fame. So it was he was a trader at Jane Street. And so his claim to fame was trading, okay? But what Alameda was actually doing most of the time was not this kind of microsecond, order flow trading, be the middleman. That was like penny ante stuff to them, okay? Forget that stuff. You only make, pennies, per trade on that. That's what, Jane Street, things like that. We're not going to do that. Instead, what they were doing is just making big bets, making big bets on crypto. And for kind of, ordinary man in the street, stupid reasons like, oh, people are talking about this currency, let's get in on it. It seems like they were not using the techniques of, microsecond trading and so forth. Instead, it was just making big bets on other cryptocurrencies.
Do you think that there was any signal though in what was going on in FTX that would give them some information about what, which coins are likely
well,
to move here?
I mean, there was a signal in that FTX would list these coins. So, like Serum was the big one. And Sam Bankman-Fried was a big supporter of Solana, which is a layer 1 blockchain. And so it would guarantee that there would be a retail market for these coins. So that creates the kind of, froth and so forth. So it's a big deal to get listed on Coinbase. That's a big deal. That usually pumps your coin. And in the same way, getting listed for a while on FTX kind of pumped your coin. And so in that sense, Alameda was getting a first look. They were thinking about things jointly, but it was not this kind of MicroStrategy trading. They would have, that is less risky because you are just doing short term, very, very, very short term. Like you're in and out in less than a second. Okay. But that's not what they were doing. Instead, they were just taking these big bets on crypto, which again is kind of crazy in that you would have hoped that they would have done some diversification. Like if I had, was making all this money on the crypto side, I would have bought, like a cement factory, okay, buy something which is counter-cyclical to crypto.
Right, yeah. Yeah, the way you describe it, it's almost like an IPO, right? There's like some kind of a relationship here going on that if you know that the IPO is going to happen and you can get in at like a lower price and what you believe the market's going to come in at, then you can make some quick easy money, right?
Yes.
Yeah. Are there any more questions about FTX specifically, or if not, I was thinking actually it might be natural for us to move on to decentralized finance and see if there's anything that could have changed this picture if we had like a robust DeFi ecosystem. Alex, can you comment on just DeFi in general? Like, what is it? Like, what?
Sure.
Yeah, like how it plays into all of this.
Right. Okay. So decentralized finance is a crypto innovation. It is new. It's a new type of way of trading, which is kind of remarkable, actually. When I first, started learning about this, it didn't make any sense. It's completely crazy. Okay. So here's the basic setup. So ordinarily, when you want to trade a stock, okay, you open an account with like Charles Schwab or something like that. And Charles Schwab has your money. You put your account in a Charles Schwab account and they trade on your behalf. Okay. And they trade on, let's say, the New York Stock Exchange with using an order book. So on the New York Stock Exchange, you have people come in who bid for stocks. They say, I'm willing to buy this stock. How much? It's such and such a price, and how many shares I'm willing to bid. And you have people who are asking, people who have the stock, and they ask, I'm willing to sell this 100 shares of this stock at such and such a price. Okay. So there's an order book. And then what the New York Stock Exchange does is they kind of match up the order book. Okay. So they make as many exchanges as possible when the bids and the asks overlap. Okay. So those are two parts of centralized finance: the order book and the fact that you are trading. You go to Charles Schwab. It's actually Charles Schwab who uses their money, and then you just have an account at Charles Schwab. And in fact, something which people don't know and which they're often freaked out to find is that when you have stocks, you have some stocks, and you have some S&P 500 or something like that, or you don't actually own those. Okay, technically, they're owned by a big company in New York, the DTC. They actually own the stocks. What you actually have is a contractual right. Okay, they owe you the stocks with DTC, and that was just done because in the 1950s, you literally got a share of stock, piece of paper, and there were all of these guys in their bicycles, running around New York City, delivering these shares, these paper shares, and the system just became overrun. And so they got rid of that system, and in place of it, everything is actually owned by DTC, and you just have a contractual right. Most of the time, it works out the same as you owning it, but actually legally you don't. You have a legal right, not an ownership right. Okay, so that's one part. So the order book and the buying on account. Okay, decentralized finance changes both of these things. So in decentralized finance, you have a wallet. Okay, I'm sure you've heard about these wallets, and the wallet is just like your wallet. You have paper bills in it. Okay, it's your keys, your wallet, and you own your whatever is in your wallet. It's not somebody else's account which you're using. It is it's your thing, like it's in your pocket. Okay, and you trade differently as well. So instead of going to the New York Stock Exchange to an order book, the way trading happens with something like Uniswap is you go and you make a deal with a smart contract. It's called a smart contract. It's actually sort of a dumb contract in many ways, because if you want to trade, Bitcoin for e-gold or something like that, you go and take your Bitcoin, and it will offer you a price based upon a very simple mathematical formula. Okay, based upon, in the simplest case, like just a hyperbola. Okay, a very simple mathematical formula, and it just gives you a price based upon this formula. And when I looked at this originally, I'm like, what? Like, what sense does this make? Prices should be determined by supply and demand. How can prices be determined by this ridiculously simple mathematical formula? Okay. And the answer to that is arbitrage, is that if prices on this formula get too far away from an actual market price, then arbitrageurs, typically bots, will come in and push the price back to basically the market price. Now, what makes this useful is that you don't need any humans actually involved. So you just go and you trade with a smart contract. The smart contract is on the blockchain. It is available to anybody in the world, with a cell phone. It is available 24 hours a day, 7 days a week, 365 days a year. So the centralized exchanges with the order book, remember, you need people who are bidding and people who are asking. So this is the reason why the New York Stock Exchange is only open like 9:30 to 4 on weekdays, and it closes on holidays, and it closes over the weekend, because they need a lot of people together all at the same time in order to make the order book thick. With decentralized finance, you're just trading against a smart contract, which is just sits there on the blockchain, and you don't need somebody else there. You can, so for this reason, you can just trade anytime you want, anywhere you want. So it has some advantages in that respect. And you're always in control of your money. Your money goes directly from your wallet to the smart contract back to your wallet. It's never put into somebody else's account. So in this sense, it's less risky in some ways than giving your money to Sam Bankman-Fried, because you never lose control over it. But it's much riskier in other ways, in that you could lose your wallet. Understanding it's much more technologically difficult to keep track of things, to do things in decentralized finance. It's clunky. The user experience is not very nice to neophytes, and yeah, it's a little bit clunky still. So that's brief introduction to DeFi.
So as it relates to FTX, so in this kind of a setup, since all of your as a participant in the exchange, since all of your coins are held in your wallet, and some other firm like Alameda could not have like used those coins to do its trading, right? So
correct.
So like in this way, like maybe it would have been a safer overall setup than what we have with FTX.
It would have been safer in this respect, not clear overall. I mean, there's a reason why. So decentralized finance, it's gotten very big, it's gotten big very quickly. I think there's about $100 billion. It was as high as $250 billion locked in some of these contracts. It's still small relative to, New York Stock Exchange and to the, foreign exchange. But I think about it as one of these Clayton Christensen disruptive innovations, which starts out small, and the big guys look at it and they just laugh, and that's crude, and it's kind of a joke. But I would be very worried if I was the New York Stock Exchange. I would be very worried, because any exchange in the world is, I think, vulnerable to a decentralized exchange. So even if decentralized exchanges don't take over everything, if they took over 10%, that is, they have a lot of room to grow. And that is also one reason why there has been so much speculation in these markets, because it's not just wrong. It's not that there's nothing there. Cryptoeconomics and these decentralized exchanges, if you compare them to the financial system as a whole, they are still a very, 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 very small part. So there's a massive room to grow. So I think it is definitely conceivable that decentralized exchanges could become much, much, much bigger. And that's why there's so much speculation here. The financial sector is, like, in the United States, like 8% of GDP. It's big. It's a big sector. So the speculation is not just hype. There's something there, but it's still very easy to lose all your money.
Sorry, I think I interrupted someone a minute ago. Was there a question? One, I think, interesting quirk, I guess, of decentralized exchanges is impermanent loss.
Mm-hmm.
Can you talk about that? And I've never actually been clear on whether or not the exchanges themselves are profitable given impermanent loss. So yeah, can you go into that?
Sure. Okay. So as I said, the way these smart contracts work is you send them one currency and they send you back another. Okay. Now, in order to do that, they need a pot, right? And the pot is provided by these liquidity providers, okay? So they initially stock these smart contracts with a pot. So if it's a Bitcoin e-gold smart contract, the liquidity providers will initially stock the smart contract with half and half of Bitcoin and e-gold, and that gets the contract going, okay? So that it can make these trades, either Bitcoin for e-gold or e-gold for Bitcoin. Now, why would anyone do that? Well, the liquidity providers, the guys who put up this pot, they get a cut of each exchange. So when you trade Bitcoin for e-gold, you get, there's a transaction fee, okay? And that transaction fee goes to the liquidity providers who stocked the smart contract. Now, the way this thing is set up is that once it's stocked, it'll never run out, okay? Because the price will change so that it never runs out. Now, ideally, for the liquidity providers, what they would like is if the price, the actual market price, doesn't ever change, because then you'll just have people with Bitcoin will buy some e-gold, people with e-gold will buy Bitcoin, and they're just making all these exchanges all day. So on every exchange, okay, the liquidity providers make a little transaction fee. And so long as the price isn't changing, people are just moving from e-gold to Bitcoin, and just as many people are moving from Bitcoin to e-gold, and they're just moving back and forth and making all these exchanges. The liquidity providers are very happy, okay? They're just making all these transaction fees. But remember that the price on the smart contract, okay, is just set by this hyperbola. It's just set by this mathematical function. If the real price differs, changes in the real world, that does not automatically change the price on the smart contract, which is just set by this hyperbola. Instead, what has to happen is you have to get trading until you've moved along the hyperbola to where the real price is. And every one of those trades, of course, is a bad trade because you're trading at the wrong price. The true price is here. The trade on the hyperbola is here. And until you make it up, okay, this is a bad price. And who is losing? This is the true price. The arbitrageurs are gaining. The smart contract is losing until you're at equality again, okay? If you just make trades like this, back and forth, back and forth, back and forth, then the liquidity providers are doing great, okay? And they're just earning all the transaction fees. If instead the market price goes here, and then the arbitrageurs push the price on the hyperbola up to the true price, the arbitrageurs are making money all the way. The smart contract is losing money. That smart contract losing money, that's called impermanent loss, which is a horrible name because it's just as permanent as any loss. Okay. The idea is, well, if it eventually comes back, you'll make it back. But that's just like saying if, the price of IBM goes from 100 to 50, that's impermanent loss until you sell. Okay. So it was a terrible marketing. It's like calling something Greenland. Okay. It's a bit of a lie. Anyway, so that is the basic deal. And so these smart contracts in DeFi, they have to create a balance whereby the liquidity providers are earning enough transactions fees, okay, to make them be willing to take the losses when the true price differs from the price on the smart contract.
Do you have a sense of typically, do they actually make enough transaction fees, or are they eating the cost of this to make sure that there's a liquid market? Or
it's a good question. So I'm a liquidity provider on some contracts, and I must admit I don't always follow it close enough to decide whether I'm making money. I suspect they do okay. Now there are things like So one of the advantages of DeFi is that anyone can create a new exchange, can create a new contract, a new smart contract, can improve the smart contract. So the contracts on Uniswap have gotten better. They have over time, in a way. So as I said, what these smart contracts want to do, these decentralized exchanges want to do, they have to get the liquidity providers. They got to provide enough profit for the liquidity providers to be willing to do that. But they also have to make the prices good enough for people to want to trade on. If the transaction costs are so high, people won't want to trade there. So it's kind of a balance. And there's lots of innovation in creating new types of decentralized exchanges. So as I mentioned earlier, the liquidity providers do best when people are just trading back and forth, back and forth, back and forth like this. Now, if you're trading two stable coins, okay, which is always supposed to be $1, like you might, there's a Terra stable coin and a BUSD or USDC or Tether. These are all stable coins. They're all supposed to trade at about $1, okay? And there are reasons why you might want one stable coin and not the other stable coin. And so people do trade them back and forth, back and forth. Those kinds of trades are great for liquidity providers. And then you can offer a kind of a different curve, not a hyperbola. You can offer sort of a flatter curve. And that is what the Curve Exchange did. So the Curve Exchange was an innovation in the field. So, so the 2 points I want to make are, first, that this is a very innovative field because, it's a big deal to create a NASDAQ, a new stock exchange, right? But new stock exchanges are being created in the DeFi world all the time. So there's lots of competition, lots of innovation, lots of new ideas. And part of those new ideas is creating more efficient exchanges so that the liquidity providers can make money, and also that the prices are closer to equilibrium prices so that more people want to trade there. And that's kind of what's going on. That's that's the action in the field.
Grin, would you like to ask your question, and then Alex?
Yeah, my question is about the details of how liquidity providers lose money, essentially. Like if I thought that you said you have to seed the pot. You have to put in, let's say 100 Bitcoin and 1,000 e-gold. And so, the price for one Bitcoin there is 10 e-gold, right? Because they're 50-50. But then I thought the way it works is as people buy one and sell the other, the price changes, and then also the smart contract ends up holding more of that like lower value one. That's how it works?
Yeah. So that's another way of kind of saying what I said. So it starts out, but that's correct. So it starts out equal, right? And then the market price of one of the assets goes here, okay? But the smart contract price is still down here because, okay, let me step back. Suppose that we hear some news like, the Challenger has blown up, the spaceship, okay? Well, on an ordinary market, the price can change immediately without any trade because the buyers, they stop buying, and the sellers realize, okay, it's blown up, whatever, and they're going to change their price. So you can have a change in price without anyone trading. On a automated market maker, we start out with equal, then the market price is here, the Challenger blows up or whatever. The only way this price on the automated market maker can get back to equilibrium is if somebody trades. Now, who's going to trade? Well, it's the market makers who then realize that the price on the arbitrageurs, then realize that the price of one of these assets is too low. And I can make money by giving the smart contract the overvalued asset and getting out in return the undervalued asset. And as they do that, that's what pushes the price back to equilibrium. And they're doing that because it's profitable. But precisely because the arbitrageurs are profiting, somebody else must be losing. Who is it that's losing? It's the liquidity providers. So that is how we get to equilibrium. It's by creating an incentive for the arbitrageurs to move the price to equilibrium. And that incentive is profit, which comes from the liquidity providers. Does that make sense?
So it's that the liquidity providers have to buy, even if like everybody knows the price is off. Okay.
Yes, because the smart contract, remember, the price is set by this mathematical function. So they can't say, no, we're not willing to take this price. It's just the price is given by this function. It's whatever that function allows. And so, the price is set in stone. I mean, it moves, it's a curve, it's a hyperbola or a different curve, but it is set in advance, and it doesn't, that's why I said it's also kind of like a dumb contract, because the price, the only way the price on a automated market maker changes is by moving along that curve. And that only happens when the arbitrageurs, when people are actually trading. There's no oracle which moves the price discontinuously to the true price. And that's what creates these profit incentives. It's as if, I tell you, I'm willing to sell you IBM stock for, $1 per share. Okay. I tell you, I'm willing to sell you, Grin, IBM stock for $1 per share. And you go out and you look on the market and you find out that IBM stock is worth $2. So then you're just going to come to me and give me dollars. And I promised to give you IBM stock for, $1 per share. And I'm just beholden. I just have to follow out my promise. And I just keep giving you a stock, at least according to some function, until I get to $2. So that's how you could take advantage of me if I made this promise to you, okay? And that's what the arbitrageurs do. And I would be the so-called smart dumb contract here.
Alex, if you have a question?
Yeah. So my understanding of the liquidity pool-based AMMs is they came in part about because of high gas fees, and because it's expensive to build the amount of logic you would need for an order book, and Ethereum is just not super efficient. So I'm curious if you think that as layer twos come up that have lower smart contract fees overall, so lower transaction fees, do you anticipate seeing order book based automatic, like I guess quote unquote AMMs, order book based smart contracts kind of rising in that ecosystem?
Yeah, I think that's a good question. The thing, you're absolutely right. The first thing people tried to do on a blockchain, of course, is to recreate what they already knew, which was the order book which is an ancient device. But let's just say New York Stock Exchange kind of order book. And with those order books, like people can make an order and then cancel it, okay, and change their order. And it's very easy to do that with a computer. But if you try and do that on a blockchain, if you want to cancel something, well, that costs you. You need gas to cancel something, okay? And every change you make, even without a trade, would involve gas, exactly as you say. So there are so many transactions on an order book that, yes, it becomes very expensive to do that on a blockchain, which requires getting consensus, across, the entire space. And that's where AMMs came in. Now, could you do something like an order book on a layer two? Absolutely. Probably we'll see something, some intermediate hybrid forms. So one of the things that a friend of mine is working on is like a New York Stock Exchange is continuous. And that is one of the reasons why there is this incentive to do front running and to get ahead, by microseconds, right? So literally people have straightened out the fiber optic cable, running from Chicago to New York in order to, because a straight line, light travels a little bit faster on a straight line than a curved line, okay? And so people have spent money straightening fiber optic cable in order to get their trades to New York microseconds earlier. Another way you could do it, however, is with a batch auction, okay? And that is it could be like every minute, but it could even be every second because we're talking microseconds. So instead, what you do is you collect everything in a batch, you run this batch, and then you run the next batch, and then you run the next batch. And that would reduce this incentive to shave off microseconds, because as long as you're in this one batch, it would be like a block. So this kind of batching seems to be very consistent with the way blockchains actually work. A batch and a block sound very similar. So he's been working, he started about thinking about these for the New York Stock Exchange, but people have asked him to look at this for blockchains. So we might see some hybrid institutions. And again, this is one of the reasons I think that the field is vibrant, and a lot of potential for creative destruction is that we have not explored the space of possibilities for financial contracts. We've only explored a tiny fraction of it. So whether batch auctions are the way to go or some hybrid form, I have no idea. I don't have a position on that, but I totally agree with you that we have only explored a tiny part of the space. And so I would be excited about seeing other ways of doing this.
Can you talk a little bit about smart contracts actually as I feel like that is like one of the fundamental sort of innovations, or the thing that unlocks innovation with cryptoeconomics, right? The ability to build new sorts of instruments, right?
Yeah. So I think, so the standard analogy for the smart contract is the vending machine, right? You put your coins, you put your gas in, and click, whiz bang, and something comes out. And that can be a lot of things. You can put your coins in, you can get an NFT out, you can put your coins in, you can get an exchange, like I saw decentralized exchange, like I was talking about. You can do an insurance contract with a smart contract. The big picture, I would say, is two things. I guess that's four, but two. One is, Mark Andreessen said kind of famously that software is eating the world, right? And like Netflix, think about Amazon. Amazon is a software company, right? It sells books, started out by selling books, but really what's going on, it's a warehousing software company. And now the books even themselves are software, right? Kindle, it's a software thing, right? And same thing with movies, right? Like, what is Netflix? Okay, Netflix is a software company, right? And what it's selling is software, but the way in which it sells is also software. So he said software is eating the world. Smart contracts, blockchain more generally, is a illustration of this in the world of finance. Okay? So the software which blockchains are building, this decentralized smart contracts, this decentralized software, it is possible that it will eat a big chunk of the financial world. That's one way of thinking about it. The second part of it is that when you put a smart contract on the Ethereum blockchain, it's there forever. So long as somebody is willing to put the gas in, the smart contract will still do its thing. And that means that these things are, in the techno language, in the jargon, composable, okay? Which means that you can take one smart contract and feed the results into another smart contract and feed those results into another smart contract. You can build them like Lego bricks. So that, from an evolutionary creative destruction standpoint, is pretty amazing, because this is all open source, okay? So you can see how these smart contracts work. They're all put on the Ethereum blockchain, so or some other blockchain. And this means that an entrepreneur, somebody who has a new idea, does not have to build everything from scratch. They have this kind of amazing commons, okay, like the common stock to draw upon. Like we talk about, intellectual property, Disney owns, Mickey Mouse and all that. But something like Robinhood, okay, that's in the commons. So anybody can take the idea of Robinhood and can do a spin on Robinhood, or Romeo and Juliet. Anybody can take Romeo and Juliet and do a spin on it, in Miami, right? Romeo and Juliet in Miami or something like that, okay? In the same way, all of the smart contracts which go onto the blockchain, go onto a blockchain, they're open source, they're available for other people to use. So this means that the possibilities for combining them, adding to them, mixing them in all kinds of ways is really pretty phenomenal. And again, this is a reason why people are so excited about this field. This is why there's so much speculation, is that people kind of see, or at least hope, that there is something of great value there. And this composability is a big part of that.
So theoretically, some entity, let's say Schwab, could put some portion of their customers' accounts onto a public ledger that only they control, right? It's not decentralized, and then create like a smart contracts sort of a system. Like, why don't we see the same sort of experimentation, I guess, in the centralized world?
Yeah, so I do think we will see a lot of companies doing just that, which is a little bit of it's both promising and a danger. Like, one thing, I've told a lot of the companies which I work with is that the customers actually don't care if it's decentralized or not. It's just a little bit of a shame in some sense, but they just care that the thing works. That's what the customers really care about. There's a small minority of true believers who, for good reasons, but who are ideologically interested in anti-censorship or censorship resistance, like library, and who are worried about the banks and centralization, and they want decentralized finance and so forth. But a lot of the users, they don't understand that stuff at all. And that's why, the reason they flocked to FTX, because FTX was easy and decentralized finance is hard. And so they flocked to FTX, even though it was centralized. And so I do think there is a great possibility here for a firm to create a more centralized version of a blockchain. That is, in fact, what Facebook tried to do with Libra. That ultimately Facebook got Stripe, and they got MasterCard and Visa. I forget they got a bunch of people, a bunch of firms together to create essentially what was going to be a permissioned blockchain. So it would have had a lot of the advantages of a totally decentralized blockchain, but it really would have been run by this consortium of 14 or 15 firms. So it's sort of in midway between totally decentralized and totally centralized. This consortium of firms would have been sort of a quasi-public entity. Now, what happened to them is that governments worried that Libra was going to become a currency, which Facebook has 2 billion users, and it could threaten their own currency sovereignty. So they got very, very worried about Libra, and they kind of put on a lot of pressure, and that eventually fell apart. interestingly, all of the Libra code, and it's pretty good code, is again open source. So there are a lot of other companies who have now picked up, a lot of other protocols who have now picked up, including one I'm advising, Open Libra, to use the Libra code to, you know, create something which is truly decentralized. So it hasn't quite ended, but it's going to take Facebook, because of they had access to so many customers, could have launched this much more quickly, but it'll take a longer time. So yeah, I think there's a possibility of doing that, and the ultimate version of that is a central bank digital currency. But maybe we'll talk about that in a few minutes, but I'll stop talking.
Actually, that's where I wanted to go next. Actually, it seems like a natural point to talk about CBDCs, and are we going to see smart contracts on CBDCs?
Yeah. So my worry about CBDCs is that from a customer point of view, they would be great. Low transactions costs, low fees. It would be potentially automatically tied in with your identity, so you'd be able to get your wages, pay your mortgage, you know, do a whole bunch of stuff with lower fees and with greater ease of use and convenience. Okay, to be very, very convenient. All right, but it also means a central bank digital currency would mean that the government has access to every single transaction in the economy, and not just every single, but they would be able to trace every single transaction, right, throughout the entire economy. So it would be financial totalitarianism. That's what China is doing. And, you know, I think one of the tragedies of what the FTX debacle is that this has increased the pressure or the incentive to do a central bank digital currency. So I see it right now as kind of as a race in many ways between a privacy preserving currency, private in the sense that it's not government run, and also private in the sense that you can remain anonymous, like cash, like a Zcash. They're probably the leading protocol in this space. So it's a race between something like the Zcash and a central bank digital currency. And I worried that the central bank digital currency, with the resources of the federal government, would be very, very attractive to a lot of people on an individual basis, even though on a collective basis, it means financial totalitarianism.
In the current system, though, I mean, doesn't let's say in the U.S., doesn't the U.S. Government have access to a really large portion of the transactions that are occurring in the economy anyways? Like, maybe they don't know at every second what's happening, but they could subpoena AMMs or something, right?
Yeah, so in theory they do, but in practice they do not. So yes, they could subpoena Visa and MasterCard and all things like that. But right now, I mean, that's hard to do. You can only do that on a individual basis. You cannot subpoena, their entire, records. So right now what happens is you have Visa and MasterCard and PayPal and Venmo and all these firms, and you got all these transactions. What the government sees is what runs through the Federal Reserve, the central bank, which is the net. Okay. So at the end of every day, one bank owes another bank some money because there's like millions of transactions between them, and then there's some net. So the federal bank will see the net, but it won't see any of the millions of transactions down here, which generated the one big netting up here. Okay. With a central bank digital currency, potentially it sees everything. It sees every single, transaction, all the transactions. So it's in theory, yeah, you're right. In theory, all the information is somewhere, but we know that that's a big difference between having the information available somewhere and having it available in a single database.
Right. I guess the key distinction here is that in the current system, the government would need to go through some sort of a legal process to get access to a lot of these transactions, right?
So you would have to go through some sort of legal process, but also, like I said, they can only really do that on an individual basis.
Mhm.
And like they don't even know who they would have to subpoena, right?
Mhm.
At the present moment. Like, do they subpoena Visa? Do they subpoena MasterCard or Venmo? With the central bank digital currency, it's all there. Everything would be there.
Right. Yeah. So I don't want to end on too pessimistic of a note. So I was wondering, Alex, just as a closing question, like what is it in the crypto space, in the cryptoeconomics space, that is making you excited and optimistic right now? And then I'll just have a few closing remarks.
Yeah. So I guess my bottom line view is that we are all clearly living more in the online world. And that is a trend that is going to continue. This Zoom, conference is only one illustration of that. I do think that there's something to the metaverse, which I know looks like a joke. Mark Zuckerberg, doing a meeting like it's stupid. Okay, but look, that is the way the trend is going. Okay, we're all going to live in these virtual worlds, these online worlds. That trend is only going to continue, and cryptography, cryptoeconomics, cryptocurrencies, they are the natural complement to the multiverse, the metaverse. They are the natural complement to living in an online world. So in that sense, all of the trends are still in favor of of crypto being used more and more. NFTs are kind of like a property right in digital goods. And as we live more and more of our lives digitally, we are naturally going to want to own more and more digital goods. So the underlying trends are still, I think, very favorable. The FTX debacle has certainly put a big dent in those trends. But the big tidal wave is still coming. It's very much like the beginnings of the automotive era, like say 1900. There were like 1,000 different automobile companies. And it was very clear we were going to be using automobiles. So the big trend was clear, but like which one of these companies would succeed and fail? There was lots of speculation, lots of hype, lots of froth. And we don't know. We're in that position now. So I'm still optimistic about the space as a whole. About any one firm in that space, I have no clue whatsoever. I'm thrilled to be associated with Library, which is like YouTube on the blockchain. I think that's great. And so there are firms which are protocols, which I think are doing really interesting things. And as we all move into the metaverse, I think crypto still has a lot of room to grow.
Yeah, it's funny. So many people came out and like, okay, crypto is dead now. People are still building.
Right.
Yeah, there's just an enormous excitement in the space. Alex, I want to thank you for your time. Where's the best place to find you on the internet?
Sort of all over. So you can find me on Twitter. And of course, I write about economics every day. Usually Tyler writes about economics every day at Marginal Revolution. I post there regularly. So you can find me at Marginal Revolution, or you can find me on Twitter, or you can Google my email pretty quick.
Okay, great. Thank you. So I want to thank everybody for showing up. Next month, we're going to have, on December 16th, we'll have Glenn Weil, and he'll be talking about Web3 and plurality and on democracy online. So be sure to check the II website for details. All right, everyone. Thank you for your time, and have a great weekend.
Thanks, Alex. Thanks, Grin. Good seeing you all. Thank you all for coming. Good talking to you.
Alex. Thanks, everyone.
Morpheus.
Take care.
Take care.